Welcome to the podcast. I'm Eric Salzman, joined by Rich Bennett and Kevin Doherty. How are we, guys?
How you doing?
Good, good. It's a special Sunday
Edition.
edition, you
Yeah.
should
Yes.
mention.
A Memorial Day weekend
Yeah,
edition.
we never sleep.
No, no hot dogs yet. No parades yet.
No adult beverages yet. That's why we have to wrap this up before noon. So ask me what's up.
Stocks?
What's
No.
down?
Stocks are
No.
up. Well, what's not up is consumer sentiment. So,
Yeah.
Yeah.
so
Yeah.
on Friday, the University of Michigan had they basically have they have a survey and they talk about how people feel now versus how they feel in the future.
It comes out every month, right?
Yes,
Once a month?
yeah, and they issue like they issue like three times during the month, like the preliminary, and then I think
Mm,
Friday would have been the final for the month.
right.
And I believe that the sentiment index was the lowest of all time since they've been measuring this. Now, granted, they didn't start doing this in the 70s when things felt really bad, but certainly for the last few decades, I believe this is the worst. They said 2022 when inflation was going berserk, things were pretty bad, and you still had kind of the COVID layoff. But now it's like, it hit the bottom. And what's incredible is while this consumer sentiment and everything seems to be going this way, the stocks just keep going up.
Yeah. So now you're gonna get some arguments, right? There'll be some smart politician who wants to get on TV, as always, for free. And they're going to say this will be a topic coming up because we have midterm elections. They're now going to say it is a tale of two worlds, right?
The
Stock
K-shaped
markets,
economy.
yeah, stock market is at the highest, but people can't afford groceries, and that's going to be a good debate. And we've had some good back and forth in both parties. That's an aside too. There's a guy we won't mention the name of the company, but because they're not a sponsor yet. But there's a guy who runs one of the biggest ambulance chaser places there is, right? Um, I think he is the biggest, the personal injury lawyer,
Uh-huh.
and he was a big Democratic donor, big, like big, to Joe Biden and the whole bit. He came out this week and said he'll fund anybody that comes up with a third party idea. He will fund that with that money that he normally gave to the Democrats.
Right.
So I think it probably won't, we're not a political show, but it's a good point to point out. It's too soon for the midterms, but I think there'll be some other smart politician that says in 2028, I'm going to run for president on this third party thing, right? Because what you have is you have like this week in the GOP, like the Republicans, they got problems, right? Like finally, or maybe not finally, but they're pushing back against Trump. They don't like this 1.8 billion dollar. What the guy from Tillis from North Carolina? He goes, yeah, this is a big pot of money for punks, right? So it was
Yeah,
like, it's this fund of $1.8 billion that apparently is going to go to Jan 6 rioters that
right.
feel like they've been wronged, but they put the big old stop button on
Yeah.
that. And then the Dems released their autopsy of 2024, and people are going nuts, right? Like what happened in 2024? So it's like it is probably ripe for some third party stuff, right? Because people are
Yeah.
disillusioned within.
Well, if Trump was running again, which I don't think he is, like this probably, I would say, is better for the Republicans than the Democrats because I think all those people who took a shot with Trump in 24 are now a little disaffected because of the war and all the other great stuff, and now the economy sucks. Like, I don't think but they're not going back to the Dems because they already found the Democrats pretty useless, which is why they went and voted for Trump. So there's probably this huge, need there's always been a huge need for a third party. Now but you got to remember when anybody tried to run as an independent against Biden, the Dems basically went to every single state and created a legal infrastructure that would make it impossible for anybody unless they had unlimited amounts of money to basically litigate and get themselves on the ballot. So these guys have already figured out how to, keep that third party or keep that individual running as an independent off. But yeah, great points. But yeah, so looking at bond market, I think this week we came back a little bit, and we keep coming back. Like the 10-year got to 465, I think, at one point intraday. It's now at about 457, but that was a big move, and I think we're getting to a point where the bond the inflation outlook is getting untethered. And we've talked about this
Well,
on. Sorry, go ahead.
as we're speaking, supposedly there are final negotiations going on between the US and Iran. And if
Mhm.
there is something announced that opens up the Straits of Hormuz,
Yeah.
you know, should the bond market, it'll be interesting to see how the bond market reacts to that. Is it going to forward look that, okay, maybe inflation is going to soften, or is it not?
I think that it definitely, every time there's even a hint of something potentially going on, the market starts rallying again.
Mm.
Now, I don't know if it's short covering or, we don't necessarily know the flows and how strong they are. But every time, and that's why we kind of went from that 465, and I think we closed at 457. So yields go down, price goes up, in bond world. So, again, every time there's a sign of hope, there's a rally. So yeah, I would say if they finalize some agreement, yeah, I could definitely see the bonds rallying. But we get back to, we've been talking about this a lot, right? Is that it doesn't do anything with regards to inflation is one component of it, but the other component is the fact that the U.S. government is borrowing, every month between twos to thirties, the 2-year note to the 30-year bond is borrowing about 390 billion dollars a month, right? That is just supply that keeps coming and coming. And it's only going to go up. I mean, we've done nothing with regard to spending. Now you got the war to pay for. There's probably all kinds of supplement programs we have to do to get people through this, certainly by the midterms. So it's like our debt is going up. We have the debt of every major G7 country, such as the UK and Germany and Japan and the other members of the EU, I think I said the UK. They're all have budget issues, political issues, and supply issues. So you've got all that. Then you got Japan again, who's like now their 10-year debt is about at 280. I think we closed on Friday, and those are guys that we look to show up at the bond auctions every month. We do that 390 billion to buy. And like I think we said before, we said a couple of weeks ago, that's been a big trade forever. They come in, they buy treasuries because they're not getting any yield whatsoever on their Japanese government bonds. And then they swap the currency. So they lock the currency in, and so they're not taking any currency risk, and they just get that yield. And the math works that it's better to buy the treasuries, swap the currency, and here's your money versus buying JGBs, no currency, just basically buying their debt. And that math worked for a long time. Well, I don't think it's working anymore. So
No.
you've got that. And then you got these hyperscalers who are going to be investment grade debt, and they think by the end of the year it could be close to $1 trillion of borrowing, either in the public markets or in the private markets. There's just massive amounts of debt. So I don't know how rates can come down too much, right? I mean, at the end of the day, just the supply needs to be eaten, and I just can't see it happening in a good way.
Yeah. Yeah, I think that point about the JGBs is big because not only would the Japanese investors buy the U.S. bonds and swap them out, but like hedge funds always did that trade, right? And now they might just say the same thing, right? They might say, "Well, look at that. The JGB is 280. I haven't seen it like that in 20 years, right?
Yeah.
30 years."
Hmm.
And
Yeah.
if enough people keep shunning the U.S. Treasury auctions, guess what? The yields are going higher, prices are going down.
Yeah, and they don't have to. It's not like they're going to be selling. I mean, they do sometimes sell. I mean, you know, the whales they call them, Japanese pension funds and the insurance life companies. But they don't even. It's not even a question of selling. It's just not showing up with nearly the same appetite that they've shown up for the last, couple of decades. And so you got that going on so you got the supply going up, the demand going down. It usually only goes in one direction as far as price. So.
Right. And you have the added factor now. Although I saw it on Friday when Kevin Warsh got sworn in as the chairman, Trump said, "Nope, I want him to be independent." I think that'll work about 3 days, right?
Well,
When Warsh says, "Boss, you told me you wanted me to be independent. We can't cut rates." He might be like, "You're fired. You're fired."
it's gonna be like we said. It's gonna be a long, long couple of years for Kevin Warsh. You
Yeah,
sure you want this kid?
yeah.
Well, right now, so remember we look at there are two like market predictors of where the Fed funds rate. That's the Fed's policy rate, which is right now it's between 350 and 375. They create an upper and lower band. So think of it as 375. So there's futures, liquid futures that trade. They're called Fed fund futures. And then there's also over the counter, it's overnight index swaps. And both of them essentially are bets of where the Fed funds rate is going to be at a certain time. And you can look and see by the different meetings, FOMC meets every 6 weeks. So you can see the probabilities based on where those contracts are, what the market believes the probabilities of a Fed hike, a Fed cut, whatever. And if you look at the September 16th meeting now, 60% 60% probability of no cut, 34% of one cut, and 5% of two. Now that's September. And if you go to December, the meeting on December 9th, now on the meeting of December 9th, right now, there's only a 32% chance that no hikes, no hikes, no cuts. 43% one hike, 21% two hikes, and 4% three hikes. And that's got to affect everything, right? I mean, Kevin, you talked
Yeah.
about it a lot, liquidity and gets us into crypto and stuff like that. Risk assets generally don't do well when that's happening.
Yeah, if that happens, if the three happens to come about, you may want to just move everything into cash.
Unplug.
Yeah.
Especially if it's because, rising costs, rising inflation. That's
Mhm.
is it because growth is so strong that they're trying to cool things down, or is it that, oil's at $150 a barrel
Right.
and meat is $10 a pound, and
Yeah. And
or
Kevin, you
I
said
guess
you
it's
said I
beyond
think
that.
last week or the week before, you're talking about how, it's not a question of price as much as supply. Like,
Yeah.
and we're running out. They're running out of jet fuel. They basically said that, and they were going through the different countries and just basically I think the inventory is the lowest it's ever been since they've been measuring I guess, global inventory of actual crude that's stored. It's the lowest it's ever been except in Iran, where they said that they're running out of places to put the stuff. And
Yeah.
I guess that's one of the plans of the blockade, right? Is that eventually they're going to have to shut down. And when you shut down, A, it takes a while to shut down, and B, it ain't easy to start up again. Like that, this will hurt Iran. I mean, Iran's already obviously being hurt, in a number of different ways, but this is one of the thought processes of why the blockade would work and bring them to the table. I don't know. So if there's plenty of supply, it's just all sitting in Iran, overfilling tanks, and they're doing the. Remember Morgan Stanley did this? I think it was they were filling up barges full of they had all this physical oil, and they actually had barges off the eastern coast that was all filled up with oil. That's kind of
Yeah.
where Iran is now. They got
They
these
would just drive around, right? They would
right.
just like go around.
All right. Um, so let's shift topics a little bit. A favorite of mine is private equity. Can't get enough of private equity, private credit. And I found something. I'm a little embarrassed that I didn't really know about this. I knew about one half of it, but I didn't know the other half. And so what we've talked about before, right? That a lot of corporate pensions, private pensions like Lockheed, AT&T, is a whole list of, I mean, lots of major corporations that had, large pension funds that they had to administer and fund. Um, they have been doing what's called a pension risk transfer. And what they do is they essentially move they give a lump sum premium usually to an alternative asset manager, or it could be either an alternative asset manager that like Apollo that owns Athene, or it could be, I mean, MetLife, all the non private equity owned insurance companies also do the same thing with these private companies. It's mostly certainly the ones that are getting the attention are the ones that go over. Essentially, a lot of them go to Athene. Apollo has been the leader. Apollo's a gigantic alternative asset manager for those who don't know them. But so what they do is they send the liability with a big lump sum check over to Athene, and then if now Athene assumes the liability, and then what Athene does is they cede they want to move everything offshore. Now you can't physically move the liability offshore to Bermuda with a lot less a lot less regulation, a lot less capital requirements. So what they do is they take this lump sum of money, they move that over to their offshore reinsurance company. They then the Athene onshore in the U.S. cedes CEDE cedes the liability to the offshore reinsurance company. Then, well, they take the lump sum payment of billions of dollars, and what do they do with it? They buy up all the alternative assets that are being created, on an originated by Apollo it could be private credit, it could be private equity, it could be collateralized loan obligations, and not the AAA kind, Richie, but the riskier stuff. So they stuff them full of their stuff, which certainly sounds like self-dealing to me. And there's about 12 major lawsuits going on in different stages where pensioners are suing their company or their former company and Apollo and Athene. They're basically saying, look, you guys, like you took our pension and you moved it out of treasuries and liquid stuff into this world where we don't know we don't know what it is or how it is, and we're just basically on faith that this is all going to work out. So in and of itself, and this is billions and billions of dollars. And again, if this whole private credit thing doesn't work, just like we always say, if this AI thing doesn't work, we got a big problem, and a problem that nobody really understands. Like there's probably 10,000 people on the planet who actually know what's going on here. And
Oh, I got the under on that. I got the under on that.
and now
It's probably like 100. Actually, probably like 50, right? So like it's probably the kids who run the models, those kids, but they don't really understand because they're just new analysts or whatever, and they run the models to put these structures together. Their immediate boss probably knows best. And then the big bosses at these places probably don't know shit. Like they just get reports, and they may know some stuff because that's how they got to be the big boss, right? They were that analyst at one point. They were that immediate boss, and but they don't know like what's under the hood today, right? That's the important thing. That's why I have the under on that, because there's probably 20 major players, and a handful of people at each place kind of really know.
And now we can add the 3 people on this podcast, and anybody listening to this podcast, know, right?
Now we all know. Yeah.
And granted, I want to give. I don't know about you guys, but I want to give a message to the 20 guys that do know that are not on this podcast. I can be bought.
It's called a sponsorship.
You don't have to kill me. You don't have to cut the brakes on my car. You just gotta, share the wealth.
Next week, you're going to see Monkey Business Podcast, sponsored by Athene, Goldman Sachs,
and we're just getting on
and the Democrat Party.
After all, we're not communists. So anyway, that's pretty bad, right? I mean, and there's a firm called AM Best Apple Mary Best, and they are an insurance rating company. They
Mhm.
just focus really on insurance, specialty ratings company that focuses on the insurance world. And they said something like, I wrote about this in Matt's the Racket, that like 76% of the insurance company world's surplus, the surplus that they keep, in case something goes wrong and they can't pay out on life policies or pensions, um, is in this shit stuff. Sorry, is in these alternative assets, and it is just skyrocketed. And so much of it is just that because Apollo, Ares, KKR, Carlyle, Blackstone, to some degree, I don't think BlackRock owns any. BlackRock doesn't, but BlackRock does alternative assets, of course, but they don't. They're not in part of this insurance game. They all bought up these big onshore insurance companies, or they have. So I'm sorry, Blue Owl, of course. Now they may be affiliated, but generally they have a stake in the insurance company and the reinsurance company, and they. But the main thing is they manage the assets. So no matter how you want to slice it, they manage the assets, and as far as I know, they have carte blanche to do whatever the hell they want. So they might as well own the insurance companies. Um, and I was like, this is bad. And we've talked about this before. Any time in our history that you remember the movie Brewster's Millions,
Oh yeah.
where Richard Pryor's got and John Candy, where Richard Pryor he's gonna get like a few $1 million, but he's got to spend it. He's got to get rid of all of it. He's got to get rid of a whole thing. And when he shows up at the end of whatever the time period is, he can't have $1 left, and all has to be gone. Well, that happens all the time, right? I mean, that's what blew up Japan in the boom years of the 80s, and then they blew up in the 90s because basically loan officers were running around the country like, don't come back until you've lent this money out, right? I mean, and and then think of subprime, right? I mean, bunch of loan brokers running around just here, like Credit Suisse needs this, they need 400 million of this, like get out there and do it, and send the sales force out there because they want to do this next crazy option arm deal, right? And those running around, anybody with a pulse is getting a loan. Sometimes people without a pulse are getting a loan, and it's people running around just trying to distribute money. Well, I mean, come on, this is the same thing that's going on here with private credit. You get billions and billions coming in the door seemingly every day, and they got to put that money to work. And granted, they have a lot. They haven't put it all to work. There is cash there that they just didn't get done. But you got to imagine these guys are competing. Like they're calling Kevin's Plumbing up, and four of them are calling you all at the same time, competing to see who can lend you the money and then expand your business and blah blah blah. But it's just it can't be this time. It's going to be different. It's the same thing again.
Yep.
So yeah. So
There was a article where it's a couple of weeks ago that no, I saw someone is what is it? So the high yield recovery rates in the first quarter of this year were down to 35%.
35.
35% from 51% a
Yeah.
year before.
We would always
So
we when we were doing the structuring stuff, the CLO business, we'd always assume on a high yield bond recovery would be about 50 cents, like you said, 51%. And the loans we would do at about 70, right? Because they're on a higher capital structure. You get if you loan money to an entity, you're on the top of the capital structure before anybody else. So you get your money back first. So that's why it's a higher recovery. But now down to 35, huh? Wow.
Yeah.
35.
That's
And
crazy.
and you don't know what's in these things. Like, and these are probably more of the bigger. This is not middle market stuff. This isn't private credit, but this is the broader the broadly syndicated loans, and that was your world, Richie, right? Where private equity has taken over a big company, and they need they're gonna put up $2 billion, and they need to borrow 6 billion, and they go out and let's say there's a lead like a JP Morgan, and then they syndicate out the loan. And again, it's a senior loan. It's high up in the capital structure, and it's secure. There's assets that is securing it. But over the years, very smart attorneys have figured out ways to kind of ring fence like the most valuable stuff, and somehow that made its way out of the collateral pool. So
Yeah.
like I can't imagine that there's not similar things going on in the middle market world. And it's just it's not going to end well. But what's really bad, so this is what so I knew all that we knew all that. But what I didn't know is that the public pensions, like Arkansas teachers, like multi-billion, huge pensions, public again now, New York State teachers, and I'm not saying they're involved in this. I'm just naming some of the big ones, California, CalPERS, all these big public pensions. They provide capital for these these pension risk transfers. So let's say Arkansas, let's say Lockheed is moving its pension, a is moving its pension over to Athene. At the same time, Apollo's going to Arkansas teachers and says, "Hey, get in on the game, right? Like you could be." They call them insurance-linked strategies, co-investment vehicles, and strategic capital partnerships. So the public pension, talk about the capital structure. They're putting up a good chunk of the equity for Apollo to bring in this Lockheed's pension. So if the shit hits the fan, Arkansas teachers, along with Apollo, they're the credits. So they're gonna be, I'm sorry, they're the equity. So they're gonna be the first guys that get hit, right? And and then if everything, so it basically it's like a loop. It's a doom loop where they are essentially the public pension is enticed based on all this bullshit. And I've seen presentations like the Fiend made showing here's how our relationship works with Apollo, and here's why it's so great, and here's why we make it a lot of money. And I'd seen that before. I was always wondering who are they making this presentation to? Because there's no more shareholders. It's not like a shareholder meeting. And then I realized this is a presentation they're probably making to public pensions, saying this is why you want to be in on the game with us, and this is how we make a lot of money. We get all this permanent capital in the form of these pensions, and these people are never going to take their money out, and it's going to be there forever. And now we can invest it in these great assets that we have, and yeah, they're illiquid, but we don't have to worry about that because we got permanent capital over here. So no, they're not gonna have any pain in the ass limited partners coming in wanting their money back or complaining that the performance isn't any good. So you've, I think you've created a doom loop where essentially the private pensions are here, the public pensions are here, the assets are here, and if these assets blow up, I mean, it's going to be a chain reaction that nobody. If you said 50 people know about this, maybe 25 people know about this. I venture to say that Steve Schwarzman knows this part of the game. So the big bosses are involved. But I don't see anybody at the Fed. I don't see anybody at Treasury. I don't see anybody in any position to tap the brakes on this, have any concept that it's going on.
And even if they know, can they? Right? What can you do? Can you
It's
tell
not right.
Can you tell Arkansas teachers you can't invest in that? No. Mhm.
And
They have bylaws.
sorry,
Yeah.
better to
But
ask
but
for.
but the good question is if it does hit the fan, like what if it's not a financial entity regulated by the SEC or what have you, what do they do? Like what does I can't see where like the Fed comes in and says, we keep picking on Arkansas, but Arkansas teachers, oh, all right, you lost $1 billion. We're sorry. We can't give you $1 billion, but here's 750, right? Are you good with that? We okay? That ain't happening. Like that is not happening. They're going to be like, yeah, you're big boys and girls. You should have known what you were doing.
Right.
Then it's a mess, right? Because now
Yeah.
underfunded pension funds, like firemen aren't getting paid their pensions.
And this has happened before. Right? I
Oh
mean,
yeah,
when Executive Life was loaded up on Mike Milken's junk bonds, right? I mean, when they
right.
blew up,
They went out. Yeah.
yeah. And there's people who, I mean, I know this. I've read that there's people out there who had life policies. The husband died, and they got a fraction of what the policy was because they didn't have the money.
Yep.
Yeah.
Crazy.
So, I mean, it's just I love this one. So one of the names of the Apollo Fund is called Apollo Strategic Passenger Funds. Come ride with us.
Mm.
I mean,
Maybe they invested in SpaceX. Maybe that's why they call it that. They'll be if you invest a certain amount of money, we can promise you at least a couple people in your organization get the first trip to Mars on SpaceX. Everybody line up.
more likely it's probably good tickets to the Super Bowl.
Yeah. I
Well,
wonder
SpaceX is,
too. What's that, Kev?
I was just going to say, SpaceX has got its IPO coming up
Yes,
Yeah.
they
in
do.
a couple weeks. Yeah,
Did the
and
Goldman Sachs get? I think the
They
Goldman
did.
Sachs got the.
They
I
did.
love them.
And they're doing it like old school style. Like literally, like call in for your orders. You may get cut back. We're going to distribute certain ways. Uh, they think the stock won't start trading if it goes out on IPO in the morning. It actually won't trade till like maybe the next day when they fulfill all the orders. Pretty
Is
funny.
that? Do they make money?
I don't think so. I don't think so. But someday, maybe on Mars, they will make money.
Well, is that when Elon puts all the hyperscalers out of business because he's going to have the data centers all?
Right. He's got it over there. No pain in the ass neighborhoods complaining about their electric bill.
Right.
I wonder too, like going back to the that public uh, and private entities. I wonder if like at these places they like do the Bernie Madoff thing, or like listen, CalPERS is in for $5 billion. We can't really let you in. You know,
I'm sure.
like these guys are like diving over each other, like CalPERS is in. What? We need to get in that. We need. Well, let me talk to somebody. I might be able to get you some.
Right.
Yeah, please do. Right.
Right. Put in for 6. We'll probably be able to get you 2, and then magically you get filled for 6.
You get everything.
yeah.
Great news. You
Great
got the
news
whole
for
thing.
you. The stock is opened a little lower. Sorry for that. That happened actually on if you remember Facebook's IPO day. That was a shit show. Like that was like really bad. Like people were like, "Whoa, what happened here?" And they call it what do they call it? Green shoe. The green shoe, which means the underwriting firms buy up more stock to stabilize the price, and that happened with Facebook.
Yeah, that's right. I remember. Well, Richie, don't you have experience with a pension fund,
Sure,
Mr. Citron, and was this the?
Yeah, that's for another day, that whole story. But yes, this is exactly what happened, though. I mean,
Exactly.
It's not private equity, but it was alternative investments that this guy was not supposed to be investing in.
Yeah.
The Orange County portfolio manager, also the tax collector, and the water department. So if you wanted to pay your water bill, you could pay Bob Citron in person, and he might be a little busy because he's buying currency protected notes from Merrill Lynch at like 500 million a whack.
Right. So the message is, again, it's another depressing show, but this has all happened before. Like it's nothing new, and it's the same. People with responsibility either don't know what's going on, or they know what's going on and don't care. But most likely, they don't know what's going on. We've harped on this a lot, that you just have this unbelievably incurious Federal Reserve that just is like, oh, it's out of the banking system. That's okay then. There won't be contagion. Like, okay, so when a few, like, look, I worked on a case where Arkansas, I pick on Arkansas teachers just because they invested in a fund run by Allianz. I think Allianz is the biggest, right? The biggest, because they own PIMCO. So Allianz is the biggest, and they had this great, it was we use derivatives, but we're always protected. It was all on the S&P, and we understand the volatility, and we buy vol cheap and sell it expensive, and blah 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 blah. And it's safe. Like your downside is protected. We always own puts on. There's always a floor of where the S&P can go. So you're only the worst thing's gonna happen. You're gonna lose 15% or something like that. And in March 2020, that thing blew up sky high, and it vaporized about $4 billion for Arkansas teachers. I think we had San Diego I think we had San Diego teachers. They dropped a cool one bill, and it turned out like the guys. And this is the guy I think you may have read it. He's going to jail. Like this guy who was running the fund at Allianz just said, "All right, boys, we're already down at, in March." Like I think it was when you remember when everything started really getting nasty around late February with COVID, 2020.
Mhm.
And that's when they lost a boatload of money. And this guy was like, "Look, guys, we're down a lot, and with our high watermark, we're not getting paid. Like, we're not getting paid. Like, in other words, unless we make all this money back, like, we're not. We're gonna. Yeah, if you lose money with a lot of hedge funds and investments like this, they can't take a performance fee until you get back to, and I don't, it may even be a management fee. You can't until you get back to where you were before everything blew up. So you got to get back to zero again." So this guy just did the Hail Mary. They monetized the hedges. They put on a shitload more risk, and then COVID really happened, and they blew up sky high. And so again, that's and someone was I read somewhere that's they were comparing it to this, like this has happened, this has happened to these guys where they get into these great, too good to be true type investments and not a lot of risk, but great reward, and boom, they blow up. And I guess they remedied themselves by suing Allianz with deep pockets, and they got the money back. So maybe that's what's going to happen. But
Mm.
then you start looking at Richie and Kevin because you remember you keep saying like, well, yeah, these companies are involved, but look, it's a small percentage of what they do. So even if everything went to zero, they'd still be fine. Blackstone will still be fine. Now that they're getting sued for $50 billion, like that, now you're talking, because those are the types of damage numbers we could see here. So that might be a little problem. And last time I checked, those guys are quite connected to everything.
Yep.
Boy,
Crazy.
you're just full of joy on this holiday weekend.
And I haven't even started drinking yet.
Yeah.
Maybe that's the problem. Maybe I
Yeah.
should have started drinking. Well,
Uh,
um, as long as we're being depressing, let's talk about this now. And this is something that I know Richie brought up probably one of the first times we did this. So I was out with a good friend of mine last night, and he's a really great programmer, really gets, and he's kind of semi-retired now, and he's really been digging into AI and how to use it and everything. And he's one of these guys, while he's programming, he's literally got the chat bots are doing other work for him. So these are guys who know how to use this stuff. And he was telling me last night, he said, I want to start a business for the fact that a lot of these companies that are using AI now think that they have to buy one of they call them large language models, like ChatGPT and Gemini and certainly Claude. Uh, and they're paying up for a lot of money to buy these AI and then use the AI in various ways in their business. Like think of a law firm or a Wall Street firm or anything like that. But the reality is there's all of these LLMs out there for free, and they're not as good. They can't do as much high level stuff as the top of the line products are, large language models, but they're good enough. Like you don't need those things to do what you're asking it to do. I'm using the free model for ChatGPT, and I'm only limited by, the amount of times I use it for the day. So it brings us to my first thing is, oh, that's a great idea. Because he's thinking of, oh, let's create a product there. We go to this big law firm, we say, look, I'm going to build a program. You're going to query what you need to get done. And it's going to determine whether, we could just go to the free guy, and just pay a licensing fee and go to the free guy and get all that work done. And you know what? If it becomes to the point where you need, then it gets elevated, and then you go to because you're getting paid per usage. I think on some of these very large ones, that's how they make their money. Um, and at first I was like, wow, that's really cool. And I started thinking like, well, isn't that bad for the profit model of OpenAI and Anthropic and Google and all the rest of these guys? Like if there's all this free stuff out there, then why do I need to pay you guys anything?
Good point. I mean,
I,
it it's makes a lot of sense, right?
And
I
then
heard I don't want to say contrarian, but I'll say the contrary take from someone who is in the space that makes sense. I don't know whether it's right or wrong. We'll see over the coming years. But he said, look, for enterprise software, these big companies, Salesforce, and the ones that have just been getting absolutely killed over the last year because of this AI threat. He said that the value in those companies is not their product, that the actual software that they are selling to companies is in generally not the best software solution out there, but it's everything else that these companies do. They know, so if you're Salesforce, you know your customer very well, you know their business very well. That all the services you provide around the software are what really add the value. And the
Mhm.
enterprise sales cycle is very long, and you have to, once these uh, get integrated into the client, it's really hard to dislodge. And that just having a slightly better version of a similar software package or slightly cheaper is not, it's not going to destroy those markets overnight. Whereas the equity market is pricing in that, Salesforce and these others are just going to keep seeing their revenue decline, decline, decline. So
Well, we're kind of all along the same path, though, because what you're saying is indeed, I think, is correct, but also I mean, what Salesforce can use AI for to basically build in these agents that kind of work with it, and what I'm saying is they can all be for free, meaning that they don't have to
they can
buy
lower
anything
their
from.
cost structure. They don't need as
Yeah,
many software engineers.
right.
Or those software engineers they do have can do things that are 10 times greater than what they're doing today.
Right. And of all these, like Richie, remember what you said about DeepSeek, the big problem when DeepSeek came out? And let's go into that a little bit.
Yeah, so it came out that this DeepSeek was offering, I forget the actual numbers, but it was like, if it's 20% of the cost of some of these other AI, products, but it can do 80% of the stuff, wouldn't people buy it? And that scared the hell out of everybody. Immediately, like people were like, "Oh my God, AI is over." And then all of a sudden, like you don't really hear about DeepSeek anymore, right? It's like, no, 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 they're no good. But I can't imagine they've gone out of business, right? They're around, Chinese,
Yeah.
right? So like, I'm sure they have hired, people around the world to push their product onto, and if I'm a purchaser of AI in my organization, a system, I listen to them, right? And
Sure.
and if the guy is honest or gal is honest and says, yeah, it can't do that, but it could do this. Oh, and by the way, let's keep going over the costs for you, right? And they keep hammering like the price, the price, the price, right? And that's
Yeah.
going on in every kind of big product there has been in history, right? Somebody's always trying to build a decent mousetrap for a lot less to get people in, right? Airlines, cars, I mean, everything. So it doesn't shock me that this is going on. I just don't know what happened. I don't understand why no one really talks about them anymore. And are there other ones, right? Are there other deep seeks,
Well, that's what this is. That's what my friend is saying is like there's
right? He wants to
tons
start
of
one.
these out there, and they could do like the stuff that I do. Like if I'm working on like I can tell you guys about working on that product I've been using that uses AI for the credit unions and the different products that this company offers credit unions. And I've been using Gemini and ChatGPT, but now I want him to go and say, well, fine, do this. Let's do the same thing with, with one of these free or super low cost AI large language models, and let's see if we get pretty good results, or maybe we get the same results. I have a feeling it's going to be the same, right? Because all I'm doing is I'm pulling generally it's just public data, public statements, like it knows all about the company that I'm looking at because they publish all of this stuff out there. So they're going through the web and they're pulling stuff and they're right for the most part, which is incredible. But what if you could do this free, and maybe in a product like I'm thinking like law firms, right? I mean, you're not going to need a lot of paralegals anymore because you don't the research could be done by I'm looking at this complaint that I'm drafting. I need case law, but blah blah blah. It'll probably return the answer in a few, less than a minute, as opposed to having a paralegal have to go research the product, the case law. So, but I'm wondering, like, I don't think that's high math or anything. So maybe one of these free ones, or maybe DeepSeek can do it just as good because it's a relatively low level problem. And then doesn't that just throw the whole profit model of that,
Yeah, I mean the one thing like the old adage, right, is and I think Buffett was big on this back in the day, like, yes, like whatever it is, the product, it's going to work, right? People will use it. Go back to airplanes and cars and all that. But you can't tell me who's going to run it,
right?
right? Like you can't tell me who's going to be the boss of this. And you could argue that with the iPhone, Apple kind of is the boss of it, but not completely, right? Like Samsung is actually bigger than Apple, right? We just know Apple in the US big, but Samsung in Europe and Asia is huge, right? So those are two guys. But yes, okay, so that worked. But yeah, I mean, there's so many different variables with these products. You can't say like that guy's going to be the boss. That guy's going to be the boss. And right now, like if you go back to the stock market now with like chips, right, computer chips, everybody's getting bought, right? Like that, every stock is going up again. Like, so what happens? Pick on Micron, right? Micron lays an egg one quarter. Does that stock go into like down because advanced micro devices didn't have that same problem? I mean, that kind of happened to Intel until recently, right? Intel was like running the show, and then they went, well, IBM. Geez, they were the computer company, right? They ran into hard times. Yeah, but they're coming back a little with this quantum thing. But you just can't. You can't say like even NVIDIA, right? Like I don't know, maybe
Well,
this stuff's
remember that,
expensive.
you remember we had that like spaghetti chart with like,
Yeah,
everything was interconnected, and NVIDIA and OpenAI are right in the middle of it, and they had all the arrows going in and out like between 15 different companies. The biggest, the Mag 7 less Apple, and then add Oracle. I mean, monster companies with huge deals. And well, what if the guy in the middle doesn't do as well as we thought he was going to do? Like, yeah, what if that guy gets replaced, or there's so much competition that now, you know what, the same dollar's got to be split up between three of the four of them versus two of them or one of them. Like,
Well, and recently, one of the big themes that I keep hearing people talking about is buying the suppliers to just the theme. So it's the old adage of who got rich in the California gold rush, Levi's jeans, and the hardware stores that were just selling to the gold miners. And so commodities have been going through the roof. Caterpillar has, been on an absolute tear because construction of all these data centers, and so pipes and all that is doing well too. And it's interesting, Richie, you mentioned Micron, which is considered, kind of the low quality chip maker. Should we say that in Intel as well? And they've doubled this year. And
yeah,
that's also classic, like, is this theme getting, are we in the late cycle of it? Because now it's the dash to trash just to buy the laggards because, Nvidia and Samsung are selling everything they can make. And so now people are like, shit, we need to buy the Micron chips as well. So we'll see.
yeah. It slips my mind. There's an acronym though. What you were talking about, Kevin. There's an acronym tied to those suppliers. It's like something along the lines of like heavy equipment, low. Maybe they're halos. Is that I don't remember the acronym. I'll figure
I
it
don't
out.
know.
But
well,
there's like a whole subsector of people saying, yeah, like buy those guys because they're selling real stuff. They're not changing their product line. They're not making any big boasts. It's like we got a tractor and we're Caterpillar, and you
Yeah.
guys need to build, and you need lots of tractors, and we can do that.
And we don't need to bet on, Google
Right.
getting the big model, or Microsoft is like, hey, whichever one of you, you still need our tractors to build your data centers. So
And by the way, will you be putting 50% down or 75%? Because that's and you have a good time in your data center, and we'll be collecting our cash and doing our job and be out of here and on to the next. Right? That's
All right. Well, let's save quantum for next week because
yeah, that's the new one. Yeah.
that's the new one that's going to smash all this and ruin everybody's dream. Um, all right. Well, good bad stuff. Next week, and we're not going to forget our Kevin's brilliant call on Toncoin. So next week we're going to talk more about that. And we're going to talk. We're going to talk a lot about just break it down. What like because I don't know. I don't really know exactly what a smart contract is, or I don't or protocol, or how that all operates within a particular ecosystem like Telegram. So Kevin's going to break all that down for us.
most people who buy crypto don't either. So you're in good company.
Yeah.
And with that, gentlemen, have a great Memorial Day, and we will talk next week.
Have a
Great.
great weekend.
Take care.